Shake Shack has captured investors' attention, but the stock isn't immune to volatility. It's down 30% from its all-time highs as of this recording. While some investors are hesitant, I see this as a potential long-term opportunity. Now, based on my 10-year forecast for revenue and free cash flow, my fair value comes in at roughly $88 per share. That means that the stock is trading at a modest 12% premium, which isn't a screaming buy. But here's the twist. Shake Shack could still potentially deliver 20% annual returns, which is why I'm still giving the stock a buy rating. In this video, I'll break down what makes Shake Shack unique, dive into its financials to see whether it deserves a spot in your portfolio. So yeah, let's dive in. And before we dive into what makes Shake Shack unique, let's take a look at a quick snapshot of how the company has performed over the past full year, which is 2024. Now, revenue has increased by 15%, and at the same time, EBITDA has increased by close to 30%. This means the company had a healthy EBITDA margin of 12%. However, the current share price has declined over the past year by close to 6%, which presents an interesting opportunity for us as investors. And the company is headquartered in New York City in the United States. Now, Shake Shack isn't just another fast food chain. It has grown into a global brand known for its premium burgers and crinkle-cut fries. More importantly, it's built a cult-like customer base. And Shake Shack positions itself in the fast casual category, where customers are willing to pay more for better quality food in a modern and clean environment. That positioning has allowed it to stand out in a crowded market. Today, Shake Shack operates over 600 locations globally and continues to expand in the US and internationally. The company is investing heavily in digital ordering and drive-through formats, all while improving unit economics. And now we come to the quiz of the video, and the question this time is, what percentage of Shake Shack's locations do you think are company operated? Now, this is versus being franchise operated. Is it A, 0%, B, 39%, or C, 56%? And the correct answer is 56%. And Shake Shack's high company operated percentage reflects its focus on brand control and quality consistency, unlike many fast casual peers that rely heavily on franchising. Now, financially, revenue has been growing at double-digit pace, and while margins have faced pressure from inflation and higher costs, the long-term runway for scaling is substantial. And the bull case for that runway is quite clear. First, we have brand power and pricing. Shake Shack has established itself as a premium brand, allowing it to charge higher prices and maintain strong customer loyalty. And we also have a massive expansion opportunity. With hundreds of new locations planned, especially in international markets, Shake Shack has significant runway for growth. Now, we have a bear case as well. First, we have a competitive landscape. The fast casual burger space is crowded with McDonald's, Five Guys and local chains all competing for market share. In addition, we have cost pressures. Rising labor and food costs have been eating into margins. If inflation picks up, profitability may take longer to materialize. Okay, so now we have a sense of what makes Shake Shack so unique. Now, let's take a look at some historical financial data going back 5 years in time. So that's 2020 all the way up to 2024. And this data will later lay the groundwork for our valuation. And here you can see the core financial performance of Shake Shack. You can see both the revenue in blue and you can see the EBITDA in green. Now, the interesting part is that revenue has grown consistently each year by 24% on average. And so has EBITDA as well, right? By 58% on average, showing that the company not only can grow its revenue, but can also become much more profitable at the same time. For instance, the EBITDA margin was just 5% in 2020, and since then it has expanded all the way up to 12.5%, which is great news for us as investors. Now, before investing in any stock at all, I like to take a look at the debt sustainability to see if that is any risk for us as investors. And in this chart, you can see the debt in the company as purple, and you can see the excess cash in green. Now, we can see that the debt to EBITDA ratio was all the way up to close to 11 times in 2020, and that's way higher than the 3 times we're targeting as investors. But we can see since then the debt to EBITDA ratio has declined quite steadily. It's down to 3.9% in 2024. Now, with time and increased EBITDA, I expect the company to be below 3 times quite soon. Now, as we later on will use the free cash flow of the company in the valuation, let's also take a look at the free cash flow performance of Shake Shack in the past 5 years. Now, here we can see again the revenue in blue, and instead of the EBITDA, we can see the free cash flow in green. Now, the main difference is that the free cash flow is much more inconsistent than the EBITDA. We saw a huge spike in 2021, a few negative years, and in 2024, the free cash flow became positive again. So that's a risk for us as investors to keep in mind of, that the free cash flow is harder to predict and harder for us to value in the future as well. Now, the final chart that I would like to show you has to do with the share performance of Shake Shack over the past 5 years. Now, this is across 2 dimensions. First, we can see the average share price per year as the green dotted line, and we can see the shares outstanding as the blue columns in millions. Now, important to add is that the share or the stock price has risen by 11% per year at the same time as the revenue has risen by 24% and EBITDA has risen by 58%. So relative to the revenue and EBITDA, the stock has become much cheaper in the past 5 years, which is a good sign. In addition, the company has diluted shareholders by 1% per year, but expect this to actually decline once the company is profitable enough to increase its share buybacks. Okay, so let's move on to where things become much more interesting, which of course is the valuation part. And here I'll show you all the key assumptions in my model just to be fully transparent, and all of these assumptions go all the way up to 2034. So that's 10 years including 2025. So in terms of revenue growth, here I'm assuming 14% per year in the coming 10 years, and in the past 5 years we've seen 24% per year, right? So a deceleration in growth as the company of course will become larger, it will be harder to grow at the same pace. Now in terms of EBITDA margin, here I'm assuming 18%. We've seen 9% on average in the past 5 years, but the company was already at 12% in 2024, so I think 18% is definitely achievable for Shake Shack in 2034. And in terms of enterprise value to EBITDA multiple, I'm assuming 20 times. In the past 3 years, it's been 63 times per year on average, so a much lower multiple as the company will increase its profits, right, and the growth will slow down as well. So 20 times I think is a realistic multiple to estimate for Shake Shack in the future. And moving on to my free cash flow growth assumptions, here I'm assuming 24% yearly growth for the free cash flow. Now that's of course much higher than the past 5 years where the company had a few years of negative free cash flow. So assuming that the company really can increase its free cash flow as it becomes much more profitable. Now in terms of free cash flow yield, here I'm assuming 2%. That's how much free cash flow we get as investors relative to the price of the shares. And finally, I've used a discount rate for the future free cash flows at 8.5%, which I think is reasonable for a company like Shake Shack. Now, if we use all of those assumptions, here you can see a complete overview of the revenue and the free cash flow that I'm forecasting for Shake Shack all the way up to 2034. Now, what's important to add here is of course that the free cash flow growth rates, which is the green dotted line, will be for most years higher than the growth rates for revenue as the orange dotted line. That's the big part of our bull case, right? That the company will not only grow revenue, but also free cash flow at a higher pace. And also to stay conservative, I've decelerated the revenue and the free cash flow growth rates all the way down to 2034. And finally, you as an investor need to keep in mind that these free cash flow growth rates will probably be much more volatile than in my model. That's part of the risk and uncertainty of investing in companies like Shake Shack. Okay, so if we discount all the future free cash flows that we are forecasting for Shake Shack into a present value of today, we get a fair share price of $88 per share. This also suggests that the company is trading at a slight premium of 12%. However, I'm still giving it a buy rating and 4 out of 5 stars, and this is mainly due to the annual expected compound return, as you can see at the bottom right, being 20% per year. Now the market usually gives us 9 to 10% per year, and 20% is then well above the market expected return. So it all depends if you as an investor believe that 20% annual return is good enough despite investing in the company at a slight premium. Now, if you do decide to invest in Shake Shack today at the current share price, this is how the investment could pan out in the bull case. Now, of course, you as an investor need to buy the stock today. That's a negative cash flow for you as an investor, but then you get free cash flow from the company each year, right, as buybacks or as dividends, all the way up to 2034, where you actually have to sell the stock at the target price. And it's basically the total gains relative to the initial investment that gives us the annual compound return of 20% per year. Now, the valuation we just did was of course based on our bull case assumptions, assuming that the company can grow its revenue by 14% per year and its free cash flow by 24% per year. Now, let's also do a quick bear case and see what happens if revenue growth decelerates to 7% per year and free cash flow growth decelerates down to 10% per year. Then our fair share price drops down to just $27 per share. This means that the current share price is trading at a 266% premium, and at the same time the annual expected compound return drops down to 6% per year. So I guess it all depends on where you as an investor believe that Shake Shack as a company could perform. Is it our bull case? Then yes, you could get 20% per year. But if it's the bear case, then it's just 6% per year, which of course is well below the expected market return at roughly 9 to 10% per year. Okay, so let's take a step back and see how Shake Shack compares to other stocks I've talked about on my channel. And here you can see a matrix where the undervalued stocks are up to the top and the great businesses are to the right. So we want companies that are up to the right in this matrix. Now, I'd actually place Shake Shack today over here. I think it's slightly overvalued. However, it's a great business, but not really on par with perhaps ASML or Microsoft. Now, if the stock price would decline and the margins would improve in the company, then it would actually move up to the right and be much more interesting. However, I do think that 20% is still good enough to add a few shares at least to my own personal portfolio already today. And I also believe that they make amazing burgers as well, which of course makes the investment much easier. Now, if you are new to the channel, what makes a great stock, in my opinion, isn't only that it's a great business and that it's well priced in the market, it needs a third element as well, which I call momentum. So yeah, let's take a look at Shake Shack's stock chart to see if the stock has any momentum right now. And yeah, here we can see a stock chart of Shake Shack going back to basically the pandemic in March of 2020, and we can see the stock has been quite inconsistent. It really hasn't had any kind of long-term consistent momentum. This is partly due to analysts having a tough time estimating the performance of the company, and that's why the stock has really been all over the place in the past few years. Now, if we zoom in a bit, we can see that stock has kind of followed this upward sloping trend channel. We can see the stock breaking above a few times and jumping at the lower end of the channel as well. Now, the good news is that the stock is 30% below its all-time high just a few weeks ago, so that's an interesting entry position for us as investors. The bad news is that the stock is below its 200-day moving average, so that's this blue line you can see here as well. So technically that's a bad indicator. We want to buy stocks when they are slightly above the 200-day moving average. Now, if you are bullish around Shake Shack, it would make sense to start nibbling at the stock today, but there is a risk that the stock could continue to decline down to the low 80s, right, which we can see is a historical support line for the stock as well. Now, if you'd like to wait and see if you can enter Shake Shack stock at a lower price, here you can see what happens to the annual compounded return if the stock price declines. In green, that's good for us as new investors, or if the stock price rises. Now, currently we are at 20%, even at the stock trading at a 12% premium. But if the stock would decline by 20 or 30%, then you could get close to 30% annual returns if you believe the bull case that I've gone through in my valuation. Now, despite the slight premium that the stock is trading at today, I've given the company a buy rating and 4 out of 5 stars, partly due to the 20% annual return and also due to other considerations in my total rating. Okay, so here you can see all the key considerations behind my final rating. Where the company has scored really well, first of all, has to do with the strong revenue growth and the strong EBITDA growth that have been really impressive in the past few years. Now, where the company has scored its worst, first of all, has to do with the debt to EBITDA ratio. It's above the 3 times that we're targeting as investors, and it also has to do with the inconsistent stock performance. This is a stock that is really volatile, and it also might impact your portfolio performance. But if you believe that Shake Shack could perform in line with the bull case assumptions, then the volatility of this stock might be worth it if it can provide 20% or higher annual returns in the coming 10 years. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. So yeah, thank you, and I'll see you in the next one.